UK consumer prices continue to see upward pressure and applying upward pressure as well to the Bank of England, which starts its two-day interest rate meeting today. The headline consumer price index rising 8.7% in May year on year. The consensus had been for an 8.4% climb. Now, this arrests the downward trend in headline UK inflation figures, which have been falling after a peak of 11.1% last year. The Office for National Statistics says rising prices for air travel, recreational and cultural goods helping keep inflation high. Falling prices for motor fuel were the largest downward contribution. Prices for food and non-alcoholic drinks rising in May, but by less than we saw this time last year. But it's the core PCI, I think, which really steals the headlines. 7.1% year on year. Now, this is the highest since March 1992. The consensus had been for a reading of 6.8%. Now, this is a real problem for the Bank of England. Adding into this, got producer prices rising 4.1% of the year in June year on year. Retail prices 11.3% year on year. Look at sterling against the US dollar. Now, this is 5-minute candles. This was the initial reaction, pushing sterling up considerably. But bearing in mind, these are 5-minute candles in the grand scheme of things. It's not a massive move. But I want to show you this because I think it's really important to understand that people are buying the pound ahead of the Bank of England's interest rate decision tomorrow. What does the Bank of England do? Interest rates are 4.5%. There are wild, broad expectations we could well see another 100 basis points to 5.5%. I think there's some economists suggesting we could well see 150 basis points by this time next year or sometime in that period. Now that, as we've been hearing, would absolutely cripple many in the housing market, those that own properties, that have mortgages, that are coming up for renewal over the next year. It's likely they're likely to see enormous and in some cases completely unsustainable rises in interest rate payments. This goes for the buy-to-let sector, which are under enormous pressures because the way to make buy-to-let work is that you lever your profits against debt. And the debt that's been piling up is held in mortgages that start to become renewable. And when you renew a mortgage from previous lows, even just a year ago, some of these mortgages were 2.5% repayments, and now these are likely to rise to something like 6% plus repayments. And when you get that sort of incremental increase, it absolutely cripples the accounts on a buy-to-let account. And it means that people who are even in their own homes are having to find enormous amounts more to pay their mortgages. This is one of the reasons why we've got sterling up against the US dollar in today's session. It's not as high as it has been recently. In the last few days, we have seen it tip up over this Thursday, this 21st of April 22 level. But sterling is nonetheless on the way up. Let me just quickly reference what's going on with sterling against the euro. We're up in today's session at 117.60. So Bank of England very much having to face the consequences of the amount of money that's gone into the economy during COVID, the amount of money that went into the economy to help support businesses, to help support individuals. Now the government's talking about helping individuals on their mortgage payments. And some economists are screaming absolute pain. Do not do this because it'll just continue to fuel inflation.